Okay, so in today's class, we're going to practice an exam standard question on the concepts of audit risks and risk of material misstatement, audit risks, and risk of material misstatement, which is covered in ISA 315. Uh, okay, so let us first have a look at the requirements. First requirement is briefly explain. So the word is explain, not identify, which means that you will have to give a reasoning. Briefly explain how each of the following sources of information will be used by Hercules and Co. to gain an understanding of Knight Electronics Co. at the planning stage of the audit, and how each of the following sources, so when we say each of the following sources, there are effectively one source is prior year audited financial statements, the other is current year budgets and management accounts. The third one is prior year report to the management. Fourth is board meeting minutes. And the fifth one is the company website. You do not need to refer to the scenario to answer this requirement. So it has to be answered like a memory-based, knowledge-based question without drawing or making any references to the scenario. Now, based on the information that we have been provided, we can see that this is Hercules and Co. is the audit firm, while Knight Electronics Co. is the audit client. So, like that ISA 315 states that you need to understand the entity, you need to understand the entity, you need to understand the environment, and you need to understand a client's controls. And why is it important for the auditor to have this understanding? This understanding is pertinent. This understanding is important in order to equip the auditor to identify and assess the risk of material misstatement. In order to identify, based on this understanding, the auditor can identify where the financial statements could go wrong or what might be the potential issues, misstatements, omissions in the financial statements. Now, if you look at uh, this question, it talks about five specific elements. So, why do you think you will use prior year audited financial statements? Because if you use prior year audited financial statements, you can understand about the nature of the client's business, the nature of client's operations. You can understand about the principal accounting policies based on your reading of the material accounting policy information. So that is where your reading of the prior year financial statements would help at the planning stage. Then comes in the budgets and management accounts. Why would an auditor read the budgets and the management accounts? These could be helpful in, for example, performing your analytical procedures. You could compare the actual results, for example, the actual revenue or the actual expenses with the budgeted revenues and with the budgeted expenses, for example, and then you could identify potential red flags. You could identify unusual variations in accounts, right? For example, if there is an abnormal movement in revenue, there's an abnormal increase in revenue, for example, you could spot that there's a potential for revenue overstate. Then comes in the prior year report to management. Basically, the report to management is the internal controls report. It is the internal controls report, basically, which details the weaknesses or the deficiencies in the internal control systems. Now, there's a report which the auditor issues to the management as a byproduct of the auditing process, because the key output of the auditing process is the auditor's report to the shareholders, to the members of the company. But there's a byproduct of the auditing process, and that is an internal controls report to the management, or the communication of significant deficiencies to those charged with governance. So, why is this report helpful? Why would we look at the last year's report to the management? We would be interested in looking at the last year's report because that last year's report is going to help you in terms of uh, identifying control deficiencies that were reported in the last year, whether those control deficiencies were rectified in current year. Because if they were not rectified, if they were not rectified, then the controls are not good enough. Your controls may still be weak, may still be deficient, and your audit strategy would have to use more of substantive procedures or substantive testing. Then comes in the board meeting minutes. Why would an auditor be reading the board meeting minutes? That could help the auditor to, identify the key developments, major developments during the year. Those developments could be, for example, from a financing perspective. Those developments could be from an operational perspective, from a legal perspective. So those developments the auditor could get to know more about. Then comes in the company website. Why would the auditor look at the company website? A company website could tell the auditor about the company's products, about the company's services, any new offerings, any customer loyalty programs introduced, for example, right? Any warranties, for example, being given. So you get to know more about the business operations. Now, technically speaking, in answering this question, we have relied upon our knowledge of ISA 315 in terms of understanding the entity, its environment, and controls. And we tried to be specific in terms of how each of these documents is going to help us in gaining understanding. So just saying that by reading the prior year audited financial statements, we will gain understanding of the entity, that's not going to help. You need to be specific. What exactly are you going to get out of it? So you see, we came up with a specific answer rather than a generic answer. And this is how we can live up or meet the expectations of the exam. Now, let us have a look at B part of the question. B part of the question is describe 8 audit risks and explain the auditor's response. Now, this is a part that we haven't covered as of now, so we're not going to worry about it for the time being. All we're going to focus on is the description of 8 audit risks in planning the audit of night electronics scope. You already understand this particular point that audit risks are primarily assessed in the planning phase of the audit. So the question is set in the planning phase of the audit. and the question is about risk assessment. So you have been given this information, you have been supplied this information in the case study, uh, and based on this, you need to identify the audit risks. So it is 1st July 2x5, your firm. Now, this is the date today, right? So your firm, Hercules and Co., has recently won the audit of a new client, Knight Electronics Co., for the year ending 30th September 22x5. Now, there's a difference between year ended and year ending. Year ending means that the year is yet to end, and that is also evident from the date given in the current date, which is 1st July, which is before 30th September. You could have been told for the year ended 30th September 2x5, but in that case, this date would be sometime beyond the year, after the year. Now, here's a very critical piece of information that you cannot afford to, ignore, and that is the information about new clients. This information about new clients is particularly important. When you're told in the case study that it's a new audit client, whenever you're told about this, there are two things that you need to keep in mind. If you look at the concept of audit risk is a function of risk of material misstatement and detection risk. And whenever it's a new audit client, there's a risk of material misstatement in opening balances. There's a risk of material misstatement in opening balances. Why? Because opening balances were audited by the predecessor auditor, by the previous auditor, who may not have, there's a risk that he may not have detected material misstatements in opening balances. So the opening balances would be materially misstated, the brought forward opening balances, because the previous auditor, for example, could not detect them. Why is detection risk high? Detection risk is high because it's a new client, and so there is a lack of uh, cake. There is a lack of cake that the current audit firm possesses with respect to the new client, due to lack of cake, that is due to lack of cumulative audit knowledge and experience. Due to lack of this thing, what happens is, due to lack of cumulative audit knowledge and experience, uh, the auditor, the new firm of auditor, may fail to detect material misstatements. There's no learning curve effect. There could be a potential lack of misunderstanding. So that is why we say that the detection risk could be higher. Knight Electronics co-sells products enabling smart building systems, which allow customers to efficiently control their security, lighting, and networking needs. The audit manager held a preliminary meeting with the finance director and has provided you with the following notes. Since its launch 5 years ago, Knight Electronics Co. has experienced high levels of growth, such that the founder and CEO William Knight is considering a stock exchange listing next. Now, if they're considering a stock exchange listing, then they might be under pressure to engage in fraudulent financial reporting so that they can show a nice, rosy picture, inflated numbers, inflated assets, liabilities, and understated, inflated assets and income, sorry, and understated liabilities and expenses. So there's a risk of material. This factor basically gives rise to risk of material misstatement at the financial statement level. I mean, there could be material misstatement anywhere in the financial statements. Either some of the assets could be overstated, but then I cannot say which of the assets could be overstated, which of the incomes could be overstated, which liabilities or expenses could be understated. That is why I'm categorizing this as a roam at the financial statement level. Then you are told Knight Electronics Co. has both corporate and domestic customers. On 1st October 2x4. Now, whenever you see a date in the exam, whether it's an auditing exam, accounting exam, or a taxation exam, get into the habit of comparing it with the year end. And once you compare it with the year end, you see that this is something which happened right in the beginning of the year. So there, if something happens mid-year, there's a potential for example, time apportionment, or if something happened after the year end, there's a potential that there could be some events after the reporting period that need to be accounted for in the financial statements pertaining to IS 10. Knight Electronics Co. began to offer customers the option to purchase a 3-year servicing agreement. This provides 3 annual services for products purchased. Customers pay for the service agreement in full at the start of the agreement. Now, if you let me picture this scenario for you. So, what is going to happen is that on 1st October 2x4, you are going to, on 1st October 2x4, you are going to the servicing agreement started, and this is going to be for 3 years, which means the first contract year is going to end on 30th September 2x5. Another contract year is going to end on 30th September 2x6, and a third contract year is going to end on 30th September 2x7. So this is effectively contract year one. This is effectively contract year two, and this is effectively contract year three. Now, payments. When do customers make payment? Customer, for example, if there's a contract which has been entered on 1st October, customers would make advance payment today. Say $100,000 payment is made today, but services have to be rendered over the course of next 3 years. So there is a performance obligation in year one, there's a performance obligation in year two, and there's a performance obligation in year three. So it would not be appropriate that that as the performance obligations are spread over a number of years, so you cannot record the entire amount of $100,000 immediately. And when you're going to get $100,000 advance payment from the customer, you are going to process an entry debit, cash, or bank $100,000. Now, what are you supposed to credit? The correct credit is a deferred liability, or also known as unearned income, also known as contract liability. Whatever name you feel appropriate, you can use that. So this is the correct entry. This is the correct entry. But what if, just imagine that what could go wrong? What could go wrong? There is a possibility that the client records back the debit entry correctly, because that's relatively straightforward. There's a possibility, I'm not sure, because that is why we call it a risk. There's a possibility that instead of crediting deferred liability, they credit the revenue number. There is a possibility that they instead credit the revenue number, which means which is essentially, if all of this $100,000 is recorded in this year, this is precisely what we call as premature revenue recognition. This is basically what we call as premature revenue recognition. I mean, revenue is recorded on an accelerated basis while the performance obligations not satisfied yet. There are performance obligations pertaining to year two and year three which have not been satisfied yet. The entire revenue is recorded on an accelerated basis in this year. Now, when you have to draft your risk, so you will first mention that there's a 3 year servicing agreement with annual services in 3 years. Now, what is the risk? If I ask you to drop the risk would be that risk is that if entire entire advance is recorded, if entire advance is recorded in financial year 2025, revenue will be overstated for the performance obligations pertaining to next 2 years being not satisfied, and deferred liability or contract liability or unearned income would be understated. You will not have recorded, you will have omitted the recognition of deferred liability while the revenue will be overstated. This revenue should not have been recorded. So you have to clearly identify the FSLIs, that is the specific financial statement line items that may be over or understated. Okay, let's proceed further. Component parts are purchased from a number of suppliers. Prices of components have been steadily increasing over the past 2 years. So prices of components have been increasing, leading to a reduction in the gross profit margin. The forecast financial statements show inventory valued at cost. Now, this is this paragraph is drafted by the examiner. The paragraph has been drafted by the examiner in a very interesting manner. If the component prices are going up, that means the cost might be increasing. But if the margins are suffering, then the selling price of the goods may be low. So there is a risk of inventory overvaluation. There is a risk of inventory overstatement if it is not written down to the lower of cost and net realizable value. Then in June 2x5, again we have a year, so we need to as we have a date, so we need to compare it with the year end, and this is something which has happened before the year end. Knight Electronics Co. decided to revalue its premises, which had previously been accounted for using the historical cost model. So in the past, they have been using the cost model, and now they are changing the method to a revaluation model. Properties with a carrying amount under the cost model of $3.8 million were revalued to $8.4 million. So there's a huge jump based on a valuation performed by management. Now, two things need to be taken care of here. The first thing is, is it okay? Tell me one thing, is it okay to change the accounting model for items of PPE? The answer is yes. There is no problem with that. But any change in accounting policy, has to be due to some genuine reasons. It looks like they're just doing it for the purposes of reporting a gain. Looks like the impression is that they're doing it only and only for the purpose of reporting a huge gain. So if that is the reason, then your PPE could be overvalued. Your PPE could be overvalued and your revaluation surplus would also be overstated. That is one. Now, because this is a change in accounting policy, they may make the mistake of going for retrospective adjustment, which would be incorrect because change from cost to revaluation model is an exception that is dealt with prospectively rather than retrospectively, despite being a change in accounting policy. Then, whenever you are going for revaluation, there are a host of disclosure requirements. There are a host of disclosure requirements. There is a possibility that those disclosures could be omitted, those disclosures could be inadequate. There is a possibility. I'm not sure. But there are a number of new requirements. And because the company has changed from cost model to revaluation model for the first time, there's a possibility that they may not be aware of the additional disclosure requirements that come from this change in the accounting model. Finance director also carried out an extensive review of non-current assets, lives, and decided to extend the useful life of plant and equipment from 5 years to 8 years. Can you tell me whether this is a change in accounting policy or a change in accounting estimate? Extending the useful life of plant and equipment, is that a change in accounting policy or a change in accounting estimate? Yes, hurry up. The chat box is there for you. Please post your answers. Excellent. It's change in accounting estimate. Now, another question. Are Does IFRS allow for change in accounting estimates? Are changes in accounting estimates permissible under the IFRS? Yes. The answer is yes. But again, that has to be due to genuine change in circumstances. And if that is not the case, then this change is not justified. Now, there are two things. For example, the change is indeed genuine. Then what is the risk? The risk is that the disclosures required for change in accounting estimate are omitted or inadequate. There are various disclosure requirements when you change an accounting estimate under IS 8. So there's a possibility that those disclosures could be omitted or inadequate. That is one of the things. The other more probable issue is that the change in circumstances, there is no genuine change in circumstances. And in that case, you are attempting to understate your depreciation expense and you're trying to overstate your PPE consequence. Remember, if you're going to say understate expenses, you're not going to get credit, particularly in the ACCA exams, because they say no, you need to identify the specific category of expense which may be over or understated. Okay, in May 2x5, again, let's compare with the year end. The year end is 30th September, so something that happened during the year before the year end. Defective equipment used by Night Electronics Co. Defective equipment used by Night Electronics Co. resulted in a small fire at its premises. The company has commenced legal action against the supplier of the equipment. Knight Electronic Co. lawyers have advised that the legal action is likely to be successful, and as a result, the finance director has included a receivable for the damages likely to be received from the supplier in the forecast financial statements. Now, if the equipment is defective and it resulted in a small fire, this could have damaged, for example, other items of property, plant, and equipment. And so there is a risk that impairment loss on PPE may not have been. If impairment loss on PPE is not recorded, there is a risk that impairment loss is understated and PPE is overstated. Right? Now, they have included a receivable from the supplier. But remember, IS 37 in these situations, IS 37 is quite clear. IS 37 says you can only record a receivable if that is virtually certain. Likely to be successful is not equal to virtual certainty, and therefore this receivable recognition may be incorrect. And so we may say that the receivable is overstated and the related income which may have been recognized is also overstated, right? Because it does not meet the IS 37 test of virtual certainty. During the year, the company's credit controller was ill and was absent from work for 4 months. Due to staff shortages, no replacement credit controller was appointed. The receivables collection period has increased from 45 days to 75 days. So you see, controls over receivable were not operating effectively. The vacant position was not filled on a timely basis. So receivables collection period has increased. I mean, receivables who previously took 45 days to pay are now taking 75 days to pay. So this also indicates potential impairment of receivable, and there is a risk that the impairment on receivable is not recorded. And if impairment of receivable or bad debts or provision for doubtful debts is not recorded, then your receivables are overstated and your bad debts are basically understated. So you need to, now again, if you say my bad debt, my expense is understated, you're not going to get credit. You will have to categorically say that your bad debts expense or your provision for doubtful debts expense or your impairment of receivable is basically understated. An instance of payroll fraud was also discovered during the year. A payroll clerk had set up a number of fictitious employees, and the wages were then paid into the clerk's own bank account. Controls have now been implemented to prevent this from reoccurring, and the clerk involved no longer works for the company. However, the audit manager is concerned that additional fraud may have taken place in the payroll department prior to the controls being implemented. Kind of the examiner that he explicitly, the examiner clearly mentioned that there could be additional fraud. Otherwise, you would have to anticipate it for yourself. You would have to judge it for yourself. So if fictitious payments are being made, so there's a possibility that the related expense may not have been recorded and the expense may have been understated. So that is basically a problem. Plus, this indicates this is a fraud risk, and there could be other potential frauds as well that could affect the financial statements, right? There could be other potential frauds as well, which could affect the financial statements. Lastly, the last line is William Knight would like the audit to be completed by 31st October 2x5, that is just within a month. Uh, William Knight, who is William Knight, by the way? Probably the CEO. Yes, we were told in the beginning of the scenario. CEO wants the audit to be completed by 31st October 2x5. Year end is 30th September 2x5. So, financial statements are generally finalized after the year end. That would take some time, and then the auditor, then the auditor would perform the audit. So this line has two implications. If the CEO wants the audit to be completed quickly, would you agree that if the CEO wants the audit to be completed in a month after year end? Why is that problematic? It is problematic from two perspectives. Firstly, this would put pressure on accounts team to finalize financial statements in a hurry. The CEO's own accounts team would be under pressure to finalize the financial statements in a hurry because they would have to share the financial statements with the auditors for being audited, and so they would have to finalize them in a hurry. And that is going to increase the risk of material misstatement at financial statement level. There could be material misstatements anywhere in the financial statements because when things are being done in a hurried manner, in a hurried fashion, there are bright chances of error. That is one issue. The other issue pertains to increased detection risk. When the auditor is under pressure, and the auditor is under pressure to complete the audit quickly, there is a possibility that the auditors may reduce sample sizes, may not obtain sufficient appropriate audit evidence, may not be obtained. There may be limited time for an effective review, limited review by senior team members. So all of this is going to basically increase your sampling risk and non-sampling risk, which would consequently increase your detection risk. So these are the keywords that I have mentioned, the keywords that I have been mentioning throughout the discussion of this answer is what the examiner would be looking for in your script. And so you need to make sure that you cover all these aspects in the required depth, the required in the required length, right? So I hope you found this discussion helpful and you're exactly clear on the expectations of the examiner and how you are supposed to draft your answers. If there is any point that needs further clarification, please feel free to put up your questions and I shall be pleased to answer them. And if everything is clear, I would request a positive confirmation in the chat box that all is well. Okay, thank you so much. Thank you so much. We've got some answers, so we can rely on the sample, right? That's all for today. Take care. Bye.